Welcome to the Big Mike Fund Podcast, where you learn about advanced wealth building strategies from real estate investing to creating massive ROI and secured retirement profits. So pour yourself a cup of coffee, grab a notepad, and lean in. Because Big Mike has got the mic, starting now.
Welcome to the Big Mike Fund Podcast. I'm the Big Mike Zlotnik. And it is my distinct pleasure and privilege to welcome Darris Cassidy, the principal at SBRE Capital Markets and a president of Fairway America. Or did I mix it up? It's the other way around?
Sort of the other way around. I'll clarify it. I'm the president of Fairway America's Capital Markets Group, as well as SBREfunds.com, and I'm a principal at Fairway America.
Wonderful. Thank you for clarification.
Yep.
Forgive my mistake.
No problem.
So we've known each other for a couple of years, more than a couple of years. We've known each other for a number of years now, and it's been nothing but a pleasure working with Matt, you, Lance from Fairway team. You guys are phenomenal, and just to mention to the listeners, Tempo Opportunity Fund, TF Investment Fund 2, and a number of other funds have been working with Fairway America, and they are phenomenal at setting up funds in the small business, small balance real estate space. They're awesome at fund administration, and they have a great new platform called Marco to help fund managers subscribe new members. So we use them on many fronts. We have nothing but outstanding feedback for Fairway team. So I'm grateful for all your phenomenal work. So thank you.
Yeah, thank you very much. Yeah, I appreciate all that. And it's been great working with you and your team as well. And glad we can be of help in all those different areas.
Thank you, Darris. So let's take advantage of this opportunity and chat a little bit about the SBRE space.
Okay.
And it's a new space. It's almost like Matt sort of started this idea, and I don't know if you defined the space, or at least you guys are leaders of the space. So small balance real estate funds is a unique space. Could you talk a little bit more about it? How do you see it? What's the opportunity? And just chat a little bit about that whole space.
Sure. So, yeah, we've been in business since 1992, and through that time, we're running our own, what we classified as small balance real estate funds. And really, at that time, they were hard money lending funds throughout the Northwest. And as we kind of pivoted our model back in 2012, we started working with small balance real estate, or SBRE, entrepreneurs around the country. And we've defined that really as anyone that's raising capital on an ongoing basis for a variety of strategies, but all of which are real estate based. And those strategies focus on assets that are below institutional style or sized deals. And that's not to say we don't do larger deals. Some of the deals that we're doing are in that $50 to $80 million range, but more of the deals that we're often involved with are either loans or equity checks in, say, the $500,000 to $3 or $5 million range. So relatively small deals that the institutional players don't really get involved with. So that's how we've defined the space and the types of people that we work with. We've worked with entrepreneurs that are executing distressed debt acquisitions, private money lending, multifamily, single family fix and flip, rental pools, self-storage, industrial, retail, office. So a variety of different strategies. And we've worked with entrepreneurs around the country to help put together their capital vehicles, both pooled investment funds that are 506 Reg D funds, where we take them through, figure out the economics, how to align with their investors, put together the documents as we did with Tempo, and help launch that fund. And then from there, we can help people through our sister company, Redwood Real Estate Administration, to do all the backroom accounting and bookkeeping, share price valuations, distributions, liaise with CPAs on the tax returns, K1s, audits, things of that nature. And then, as you mentioned, we have our new technology company with the Marco product, and we can maybe get into that. And then we also have the group that I run, the capital markets team, which is relatively new to us. We've started about a year ago raising money on behalf of other people. And we do that through myself and my team of registered reps and our broker dealer. And so that's really the team that I head up as the president of the capital markets group. I oversee all capital raising activities and investor relations. So.
That's great. Thank you so much for the overview. And I've interacted with Fairway family of companies on many fronts, including with you and the deals that you guys syndicating in your own, I think Fund 6 and 7 invest in are very strong deals. Very happy to be working with you. And we're happy to participate in some of these deals because I think you have pretty good process and pretty strong team. So
yeah,
I've interacted with your, I guess, capital markets team. I didn't even realize the term, but that's now I understand. It's the broker dealer interface. Because you're not directly licensed as broker dealer, but you use a broker dealer for capital raising activities. And I think
So to clarify, though, we use a compliance broker dealer. So a lot of people think of broker dealers as a group that goes out and actively raises on behalf of a sponsor, and there definitely are those capital raising BDs. In our case, we use a broker dealer out of Salt Lake City, and their role is to make sure we stay within compliance, what we can do, what we can say, our marketing activities, things of that nature. And then I am a registered rep of that broker dealer, as is a few other people here in my office. And so we are the ones that are actively raising and then just have to comply with all the securities laws and FINRA and whatnot.
Understood. Thank you for clarification.
Yeah.
And I did want to make this comment on the fund administration and the fund setup component of your business. As a fund manager, I feel my job is really focused on few activities, and you guys take care of everything else. And these activities that I'm focused on is capital raising and deal underwriting. And basically, I follow Warren Buffett's philosophy. Decide how much money to invest and in what to invest. And sort of deal origination and deal selection is a function of the fund manager and capital raising. The rest is outsourced to you. I have to say that now we're going through end of the year, 1099 time, closing of the quarter, and your team is just active, working away, asking questions, helping close quarterly books, helping get 1099s out. So all that stuff is just very helpful. It helps fund managers do what they do best, and you do what you do best. And one of those things is fund administration. So I wanted to give you I wanted to give you listeners the feedback. That's your strength, and we're happy to be a client of yours and leverage your strength and focus on our strengths.
Yeah, thank you very much. That's really what a lot of our businesses are based around, is the idea of allowing SBRE entrepreneurs to focus on what they should focus on and what they do best. Just like myself, I mean, I am a SBRE fund manager, and the idea of doing the administration myself or figuring out technology solutions or, how to structure it and the documentation, all the securities work, it's just a lot. And the entrepreneurs that we deal with around the country really are focused on the real estate and then also, capital raising. And capital raising is obviously a very difficult thing that a lot of real estate focused people struggle with. But that's something that's more difficult to outsource. And so if you can outsource the administration and the technology or investor portal and even some of the structuring and economics, financial modeling, things of that nature to groups like myself or my teams, it's a better use of time. So you can focus on scaling your business and the parts that you're best at. So.
Yeah, I agree. Not 100%, but 1,000%. So
yeah,
exactly what I think. So let me ask you a couple of very quick questions. Just and I obviously I know the space very well, and we operate in the space. Just for the listeners, so what's the difference between kind of SBRE funds and REITs? Because everybody knows about big REITs, and SBRE funds seem to focus on much smaller deals with obviously capital requirements significantly lower, than the REITs like to participate. So beyond the size of the deal, what are the differences off the top of your head do you see between SBRE funds versus kind of big REITs?
Yeah, there's a few things. I mean, just one of the things that the REITs have going for them that SBRE funds do not is the idea of liquidity. You know, as publicly traded companies, you can hit a button, liquidate your position, get cashed out. I think one of the knocks on SBRE, if there is one, is the illiquid nature of the investments and of the investments into the funds. So that's a comparison, I think. But because of that differentiation, the SBRE funds that we work with oftentimes have what we classify as a liquidity premium. So they're often generating higher returns than REITs. And it's not necessarily because of much greater risk. It's oftentimes because of that liquidity premium that the investors are able to get a higher return because they're locking up their capital for some period of time. Now, I say all that, but there are, you know, open-ended SBRE funds and there are closed-ended ones. So as an example, the Fairway America funds are open-ended funds. So after a 2-year lockup period, the investors can request a redemption, which is not guaranteed. It's best effort of the manager, so forth and so on. But at the same time, it does provide some liquidity options. So it's not that liquidity doesn't exist. It just doesn't exist with the push of a button. So that's one big differentiator between SBRE funds and REITs. You know, one of the beneficial aspects of SBRE versus REITs is that SBRE investors get the benefit of all the tax pass-throughs, so depreciation, things of that nature get passed through on the K1s to investors, whereas on the REITs, the investors do not get those depreciation benefits, and those can be quite significant, and especially for high net worth people, you know, looking to offset some of that ordinary income, you know, the depreciation benefits is real money. So I think that's a big benefit to SBRE funds. Another one is just, you know, guys like yourself and myself, you know, my investors can get a hold of me or anyone else on our team, Matt Burke, our CIO, CEO, and they can come out and meet us, look us in the eye. And so we're not this massive company that is untouchable to the investors. So I think there's benefit there. Part of being smaller than some of these REITs is that we're much more nimble. We can kind of pick and choose strategies as markets shift and cycle. And we've allowed some flexibility, at least within the Fairway America mandates, as to what we do invest into, with the idea that we can be more nimble and often go after deals that fall above mom and pops, but below institutional. So there's not a tremendous amount of capital going after the same deals that we are. And therefore, the returns and yields can be you know, better than a lot of these large institutional style deals where they have so much capital to deploy and there's so much competition for the finite number of deals that they're going after. They're paying, you know, 3 and 4 caps for deals, whereas, you know, we're often seeing deals in the high single digits or even double digit cap rates. And a lot of that is because it's such a fragmented and inefficient market space that we play in. And again, it's around the nation, so there's plenty of inventory to go around and make investments into. But you know, that's kind of how I view the difference between REITs and SBRE funds.
That's phenomenal comments. I wanted to kind of reinforce what you just said, because I spend a lot of time traveling and meeting with our clients and kind of improving the relationships. And what we do is about 2/3 hard money loans and 1/3 sort of long-term deals. And this is sort of helps our liquidity. This is a very good point on liquidity, but the funds that invest in the short duration bridge loans have a little better liquidity versus, you know, pure long-term deals. So from that perspective, I totally feel your pain. Not only that, as a fund manager, it's a pretty significant priority for me to be able to meet the pref that we have of 7% in the Temple Opportunity Fund. And also we're doing long-term deals. So we are always cautious of investing in the deals ground up or redevelopment or very big value adds. So that's a very important point, but I wanted to stress this point, the liquidity can be fine, even though it's sort of a worse than publicly traded REITs. But depending on the strategy, liquidity can be good. And then the second,
absolutely, yeah,
and I know you guys do the same. Meeting the pref is really important for fund managers. And the other point I wanted to mention, because reflecting on what you just said, is that having a focus on smaller deals, not necessarily tiny deals, but smaller deals, provides a whole lot more flexibility, as this space is a lot less competitive. Big REITs are not chasing these deals with humongous amount of capital, so the funds are much more scarce. So the small entrepreneurs prefer, and they don't have a choice to work with big institutional investors. So the consequence of this is that the opportunities are much more interesting. And you're right, this is the premium. I guess lower liquidity, a little bit higher rate of return. In many ways, it's more than a little bit higher. These returns in the SBRE space could be significantly higher, theoretically, potentially, depending on the deal, than the classic REITs who buy retail. I'll give you an example, kind of interesting. I mean, these projects we actually both invested in, and we know that the self-storage facility, we're not going to mention the name, but and we have other investments in the self-storage facilities. Actually just came from a self-storage conference, Academy. And what's interesting is that these projects get built from ground up or redeveloped or improved, and then the REITs come in and buy it retail. They pay full price for the full value add projects, and they buy them at the low cap rate, while the value add entrepreneurs take it from, let's just say, ground zero or pretty low point of redevelopment all the way through different phases. And the returns in that work, and that value add work, is significantly better than retail returns. Just wanted to stress that point.
No, that's exactly right. I mean, you mentioned the one deal that we just participated in together, the self-storage, but that's also the case with a lot of the multifamilies that we're doing, where an entrepreneur has been chasing a specific deal for sometimes years, gets their hands on it, and the REITs are not interested in it because there's a lot of sweat equity and labor that needs to go into adding the value to these things, and so the entrepreneur gets in there, does their magic, and then the exit is oftentimes to a REIT or a large institutional style buyer. And to your point, by that time, the value really has been created rather than value being made just off of appreciation, which a lot of times, some of those institutional style investors are going for the cash flows, certainly, and what they can get off profit splits. But we see it ourselves as investors of sponsors all over the country. Some people really bank on the market taking care of their returns, and appreciation being a big part of that. Especially at this cycle or this stage of the real estate cycle, I don't like the idea of just putting my money in and hoping the market works out and cap rates go down and hopefully I get higher rents and then maybe I sell it for more. I like to be able to control the destiny more so. And of course, you're still at the whim of the market cycles. But, if you can get in and truly add value and acquire things that are below replacement cost, where the rents are oftentimes well below market, and to get it, bumped up to market or even still below, and create that value and not be banking on interest rates doing specific things or cap rates, moving in your favor. That's really what we're able to target and go after. And I think because of that, generate strong cash flows, but also appreciation along the way.
Yeah, I think it's a great point. I will reinforce this point one more time because this is what I think about. I think of value add forced appreciation. That's the magic words, forced appreciation versus natural appreciation. It's just the wave or the tide that raises all boats. And given today's environment where interest rates are going up and sort of yields are compressing as a consequence, it's unlikely that the natural appreciation will do the trick. The only possible answer would be economy booming, demand for all real estate's booming, and rents increasing. All the commercial properties trade essentially at a cap rate, multiple of rent, multiple of income. But forced appreciation is the only approach. It's not a guarantee, but it's a strong probability that there will be growth in the asset value because depreciation is forced versus natural. So the projects we've been looking at, we're looking at some new, these are the projects outside of your kind of ecosystem. And we're looking at a lot of projects in your ecosystem too, and we love them. You guys bring forward very strong projects. And I wanted to say that your ecosystem and your underwriting is very strong. And we're very happy when you bring files to the table. We're very excited to look at them and to co-invest along with your fund. It's almost like this. I think of this way. When you have one head that's good, when you have two heads, it's better. So when you have you're the lead head on, I guess, on these projects. And when you're investing, I feel so much better. I was listening to your podcast with Matt, and then you said something along those lines that you have no plans right now to just bring the deals and let entrepreneurs just invest into them. Unless you invest into these deals with your funds, you're not bringing these deals to the market. And that's a very important point. I guess you put your money where your mouth is. You're basically committed. You're not selling stuff that you don't participate in per se. So
that's exactly right. And a big part of that for us, I mean, one of it is, putting the money where our mouth is, but the other one is just that we're such thorough and diligent underwriters that we don't want to put deals out there that we haven't really taken a deep look at ourselves. And so, as you know, Mike, one of the things that we do is we underwrite deals before we announce them or put them out to the world. And we're really underwriting them to figure out our interest from our funds. And if our fund is interested, then the next question is, how much of the deal does the fund want to take? And if it's all of it, then the fund takes all of it. And maybe if it's a $10 million equity check and the fund only wants $4 million, we'll put the other 6 out to our investors along with all the due diligence that we've done, which includes, depending on the deal, but background checks and appraisals and loan documents and site inspection notes and what operating agreements that we negotiated and wrote oftentimes through our securities counsel. So, I think because of that, it's interesting for our investors to be able to piggyback off of our due diligence. But what has occurred that's interesting to me is guys like yourself or a number of our other investors that are sophisticated and either managing their own funds and or managing family money, or, they're just real estate people in their own right, having them review our due diligence and ask intelligent questions and even try to poke holes here and there has just made us better and better underwriters as we've continued to roll these deals out. And so it's been a fun process to really get the capital markets group up and going and raise money on behalf of others.
Yeah, that sounds really great. And I have to say that I appreciate the relationship with you, Matt, Lance, because I learned on the way. But what's very interesting is the last deal we invested in, this self-storage conversion in Cleveland area, I wasn't going to invest. And then I didn't like some things about the deal. But I spoke with Matt a little bit, and he gave me some interesting information to think about, and we decided to participate. By using all this knowledge, and I've gained quite a lot of experience working with you and also going to various seminars and trainings. We've been growing in the self-storage space, very interesting, unique space, and I'll have another, I'm not sure if you've heard of Scott Myers. He has a self-storage academy. He's a good friend of mine, and he'll come on the podcast on a future episode. And we're looking at a couple of his deals, and I'm scrutinizing them with experience, seeing things that come from you guys. So I have to say that's collective intelligence. Let's just call it that way.
Right? Yeah, exactly. I'd love to connect with Scott and just see the type of deals, because like you say, I mean, I'm dealing with different self-storage sponsors around the country. You can see different ways they look at deals and locations and site selection and whatnot. So it's interesting to triangulate everyone's thoughts and see, who's on the same page or who's kind of out to lunch.
Yeah, I'll make the introduction for sure. So anyway, a couple of other quick questions on just curious on the fund administration side. I just wanted to ask a couple of very, very, very basic questions. So how does fund administration differ for a big fund versus a small fund? I can tell you that at the end of each quarter, we'll work with your team to close the deals and close the books of each fund. And it's sometimes it's a great process, sometimes it's a lengthy process, because I guess it takes time to underwrite but to close the books of every asset that is in the portfolio. And that's, I guess, one of the interesting side effects that publicly traded REITs. You see the ticker price on January 1st after December 31st, and you get the price.
Mm-hmm.
With SBRE funds, it takes a while. It's kind of the hard money funds takes 3 weeks. The equity fund sometimes takes 45 days to get the books closed. There's nothing wrong with the process, just takes a longer time. But I wanted to hear your thoughts on this whole process.
Yeah, no, that's good. You're absolutely right that the lending funds are faster because they're relatively simple. You've got a loan, and unless there's impairment, there's not a whole lot to do. You've booked the income presumably throughout the quarter. So end of the quarter comes, it's pretty easy to value the loans, peg your share price, and move on. So there's that. And then on the equity funds, it definitely is more challenging because you need to get to that net income of every single one of the underlying assets in order to then determine the yield for the prior quarter, make that distribution. But then also it's upon the manager and these open-ended funds that have true, ownership of assets to peg the value on the individual, assets, whether that be multifamily or self-storage or whatever it may be. And that can take some time depending on, what internal processes that manager has. So I think on our end for Redwood, a lot of what I hear from them is that they're oftentimes moving faster than the entrepreneur. And that's not always the case, certainly, but a lot of times it's the entrepreneur that needs to feed them the information in order for them to get their job done. At the end of the day, they're accountants and they're very black and white and everything is factual and fits in a certain box. And if they don't, so there's no real room for them to use their own judgment on things. They need facts from the entrepreneurs, the fund managers. So that can delay things. And then of course, when you get into, there's those two fund types, then you get into the funds like the Fairway funds, and, we're pulling our hair out at the end of each quarter, even though we own a real estate administration company, because not only do we have hard money loans, but we also have ownership of deals and we have fund of fund investments all within one fund. And so to be able to peg a value on those assets is, we have a stated value methodology that we follow. And so we definitely have our processes in place, but to gather all of the underlying information of every single one of our assets and then do the accounting, it takes time. And so, that's kind of the difference. The size of the funds does not matter as much necessarily as the type of fund, asset types, as well as just how well dialed that fund manager has their processes. I would say to your point though about REITs, that 12/31 happens and then on January 1st they already know what that share price is. It's just a different animal, and that's really because that's an efficient, the stock market in theory at least is an efficient market. So you have willing buyers and willing sellers at all times, and these privately held funds just don't have that type of efficiency. So it's really up to the manager to peg the values, and of course in doing so, there is some subjectivity to that, but we're not incentivized one way or another. We don't get paid one way or the other, no matter what that share price is. So,
yeah, understood. You have the three complexities. I only have two, because you've invested into other funds. We have not done that, but we do have investments in the long-term equity deals, and those each underlying asset has to close, and the hard money loans are relatively easy. So. Yeah, right. I share your pain a little bit. Just a very quick question because we're running out of time. So, any thoughts on general yield compression in the deals? In other words, are you still seeing high quality deals or sponsors coming forward? I looked at a couple of deals recently, and I see prefs coming down a little bit. So before the pref was 10 to 12, sometimes 11, sometimes 10. Now I see some deals in the 8 to 10% pref. So a little bit of yield compression happening, at least on the surface. Is that the operation?
Yeah, and let me touch on that. I mean, I've been saying for a few years now, and it's really obvious at this point that yields, especially on the hard money side, started falling years ago, maybe 4 years ago. You really started seeing it at the epicenter, at least from my purview as being on the West Coast, or maybe it just is what it is. But the Bay Area, because of the amount of capital down there, you really saw yields drop pretty quickly. And where hard money lenders were making deals at 10, maybe 11%, and now they're making loans at 6.5% and 7%. And not even for the same deal. Oftentimes their advance rates are higher, so they're lending out more money, higher LTVs at quite a bit lower interest rates. So you definitely started to see that on the lending side. I have seen that spread throughout the country. There are certain markets that seem to maintain their yields, but you are seeing LTVs go up. Again, not across the board, but that's the trend around the country, and it continues to happen. So riskier loans, lower yield, that's making it challenging, at least for our funds, to identify loans that we really like. Because if I were a borrower, I would go somewhere else oftentimes and get cheaper money and more money. And that's what we're up against there, right? And similar is happening on equity, though.
Yeah, let me make a very quick comment on the debt, and then let you talk about equity. So on the debt side, you're absolutely right. We've seen this yield compression everywhere. So we no longer invest from our own funds at these low rates because we have secondary markets. We could sell the paper. So the decision is let somebody else take the risk. But we do invest from our funds into a lot of the turnkey hard money loans. So we work with a lot of turnkey operators, and these are small loans. So we're talking about $60,000, $70,000 loans with property value of $100,000. And these loans, yield compression, have not come down because big boys don't want to make those small loans, not enough money for them. We have to operate in that space. So that space is still maintaining reasonable pricing. So we're happy, and we compete in service. So the price, it is what it is, but high touch, high service delivery makes a big difference. But in the big markets, forget it. It's just, it's crazy what the yields have come down to. And we can't possibly invest from our funds. It's just whoever is doing this is taking too much risk because the risk-adjusted return is just not healthy on those deals anymore.
I completely agree with all of that. That's our view as well.
So what's happening on the equity deals? Because I'm beginning to see a little bit of this happening on the equity deals where the prefs are compressing. So are you still seeing that? Is that happening a little bit? Not as bad, but a little bit of that. I could tell. The guys
it's happening.
10 for pref now. They're trying to push it down to 8.
Yeah, I think it's happening, and I don't know if that's necessarily caused by the market, meaning the real estate market and the value of the assets or the cash flows, or if that's being caused from the capital side of the equation and investors, more investor capital flowing into the space and a willingness to accept lower yield and prefs and whatnot. I think part of it.
It's exactly that.
Yeah.
Forgive me for interruption.
Yeah.
I talked to a lot of the CG guys. The CG stands for the collective genius, really smart guys, and that masterminds. I call them they're too smart for their own good.
Sure.
They're brilliant guys, very smart, and they are often getting cheap money from just a lot of friends and family and then folks who have invested in the past. So they do come to us for capital when they have an overflow or the deals that are not, classic deals. But the reality is that they are getting, just more money flowing in the space. That's what my observation is as well.
I think that's right. And to the comment you just made, that idea of cheap money and people basically arbitraging money into our space. So as an example, I had an investor lunch last week with a guy who owns a good sized multifamily property. He owns it free and clear. He's planning on putting a, Fannie or Freddie type of multifamily loan on it, borrowing money, say 3 to 4.5% interest, and put that into our fund. So for that guy, he's not seeking a super high yield. He's just seeking a yield that's better than what he's borrowing that money at. And so, because of that, I think, and I've said this for a long time, investors are not as yield sensitive as people make them out to be. I think more so they're looking for sponsors that they trust and that are managing their money well and investing it wisely with their investment objectives, at hand. And if you read through our documents as an example, one of the primary things is the protection of principal and that investment, in that investment. So I feel like as long as you're doing well by your investors and putting them into good risk adjusted deals, they're not necessarily trying to hit it out of the park every time. And therefore I also feel because of where we're at in the cycle and how the hot stock market is, people are just willing to move closer to at least what they perceive to be a safer place, which may mean lower yield.
Yeah, that's exactly how I feel. I follow Benjamin Graham philosophy that investments must have safety of the principal and a reasonable return, and that's the key. So I completely agree with you. And another interesting comment: the folks that we work with, one of the key, and I think you underwrite the same way. Our number one underwriting criteria is the person. So you want to work with people who you like, know, and trust. That's the basics of the investing. If you underwrite the people, you think they have the right philosophy, they have integrity, it's a great foundation. Then you look at the deal, and by working with these type of sponsors and borrowers, your chances of success improve. They will be able to persevere through difficult times. And that's the foundation of, I guess, any underwriting, any deal selection is working with better people who act responsibly when there are difficult times and they maintain high integrity. And that's why I like working with you guys, because you guys have phenomenal integrity, and this is how you underwrite too. So. Yeah,
exactly. I agree with all that. I mean, and like you said, during difficult times, who do you want to be invested with? I think that's a key to it. Because the markets will cycle, and that's not to say everything's going to fall apart, but you want solid communication and just honesty and to know exactly what's going on as an investor. So,
yeah, I greatly appreciate this. I got to crack a joke on the Bitcoin and the people who are not happy with real estate returns, you are welcome to speculate in Bitcoin.
Exactly.
I have a lot of friends who speculate in crypto, and I tell them, the laws of gravity things that come up will come down. So I appreciate 10 times in 1 year or whatnot can crash 10 times as well. So
yes, that's right. That's a wild ride, that crypto.
Yeah. It's interesting, but we'll have another talk about crypto. I've had a couple of discussions, and I was going to invite some really smart guys who are into crypto, and they believe one of the most interesting observations was statements that I heard from really smart people. They told me that given all the projections of their own analysis on the smart people, Bitcoin and many other cryptocurrencies expect to appreciate only 350 times in the next few years.
Wow.
Only.
I'm not gonna comment on the likelihood of that or not, but yeah.
I just want to say, the moment you think about that, you hear that, you're gonna think Bernie Madoff or whatnot, or the craziest Ponzi scheme you can imagine. This thing is gonna crash. So
yeah, that's way too good to be true, in my opinion.
I agree. Back to the real estate. So would you be so kind as to share with my audience how they can find out a little bit more about Fairway family of companies? What's the website and all that interesting?
Yeah, happy to. So give a few websites. We've got fairwayamerica.com. And that site, as investors or entrepreneurs, there's a lot to learn and read about there. We have the website SBREfunds.com, and that's our investor-facing website. We've got Redwood REA, which is Redwood Real Estate Administration.com. So Redwood REA is our administration group. Our technology company, Fiducia Labs, you can Google that or find us through one of the other sites. And that's how to best find us and read about us and get a hold of us.
Darris, I greatly appreciate your time and your insightful information and sharing of your vision and the strengths and all the phenomenal information that you've delivered. I really appreciate it.
Absolutely. Yeah. Thanks for having me, Mike. Good seeing you on the video here, and we'll talk to you soon.
Thank you. Take care.
Thank you for listening to the Big Mike Fund Podcast. To receive your copy of Mike's How to Choose a Smart Real Estate Fund book, head to bigmikefund.com or visit Amazon and type Mike Zlotnik. Keep listening and keep investing Big Mike style. See you on the next episode.